There was a time not too long ago when investors were shy to go near CDOs. Derivatives had a bad name. Financial companies were hit very hard and desperately needed revenue and investor faith. Today we laugh at the financial and housing crisis. It was so obvious what the problems were. And the dot-com bubble, even more obvious then. Everyone is able to recognize it in the rearview mirror. Somehow in the middle of it, impossible to see. Today the market is pumped up with Fed fiat garbage. Investors have been loading up on the new fancy of this cycle, the ETF, while they have allowed investors to invest capital easier and reduce fees. There is one major underlying problem. And that's why you came here for the truth. So let me unveil that for you. Today we're going to talk about why the house always wins. I've got some important information to discuss, and that is related to ETFs. We are going to start by talking about what has happened in the market. I'm going to show you how the ETFs have expanded over the years. We're going to look at what's going on underneath it, and I do believe everyone should pay attention. Here you can see the stock markets. I'm just showing you the NASDAQ, but all of them have basically done the same thing, and that is gone all the way up. They never stop. We're looking at the NASDAQ heading towards 10,000, the Dow Jones 30,000, and the S&P, hey, might hit 4,000 before you know it. The predictions for the stock markets from all these financial analysts had been very bullish. They were showing anywhere from 3,300, maybe up to 3,500, and already we have seen some of their predictions being hit, and we haven't even exited January yet. So this 3,500 prediction on the high end looks really conservative when you see how fast this has come up. Just in the last few months, since QE4 has been put into place, we have seen the market basically going up almost every single day. There have been little blips along the way, but clearly we've head in this direction for one specific reason. And what investors are doing today has been that they are putting their money into ETFs. This is largely what people are doing right now because, as I said in the introduction, they can reduce their fees and they can invest more capital as a result. It makes it easy for them because they don't necessarily want to be stock pickers. They're not stock pickers, so they can get a broad index and they can get themselves the returns that they want. They've seen the progress so far in this cycle and they are very pleased with it. So a lot of money is going in there, as well as the huge companies are also getting into it as well. Why irrationally bullish investors are getting nervous as the stock market races to uncharted territory. I thought this was interesting because I've been seeing a few of these articles titled similarly, and what we're seeing right now at this time is that valuations don't matter. None of the particular indicators matter anymore. All that matters is that there is euphoria, that there is optimism, and that will make the market go up forever. Nothing could actually make the market go down at this point, according to the vast majority of people that invest. That's when you know that something's wrong. When that belief is out there, something is truly broken. Look at what has happened to the ETFs over the years. We have seen this expand. I'm just showing you this one particular chart. It doesn't even have the most recent data, but just trying to give you an idea of what has happened year over year. And looking at this back in the last cycle, if you see leading up to the financial crisis, the ETFs were still in their infancy. They were still small. It's nothing like they are today, nothing at all. So we don't know exactly what will happen in the next financial crisis, but there are some fundamental aspects that need to be discussed, that need to be understood, particularly for the small investor. If you've put your money into these, what is your exit strategy? When do you plan on exiting? Do you ever intend on selling? Is it part of your play money that you've been putting around? Is this part of your retirement plan? I mean, you got to know what this is about. It's not simply a matter of dumping my money in and hoping that things continue the way they have been. Stocks appear detached from reality, rallying for two things that may not happen. As I said, there are some other articles that share some of the same information. There was one particular reason why I'm showing you this article, but in here they're saying that we got to look at what's happening with earnings because the projections are so excessively high, and yet they're not going to be able to meet that. The US manufacturing sector has been contracting since August as stocks rallied to new records. They're ignoring the real data. But this is the key one right here. The increase in the Fed's balance sheet has been in near lockstep with the stock market's climb. This is what I've shown you so many times before. We look at the S&P 500, we look at the Fed's balance sheet, and they mirror each other constantly. We see it over and over and over again that as the balance sheet moves, so does the stock market. And we can clearly tell which direction the balance sheet is going. It's unbelievable. But I wanted to bring it to you, obviously, because this is something that I say all the time. A theory on who's doing all the buying that's pushing stocks higher and higher. With stocks at record highs, the obvious question is who's doing all the buying. It doesn't appear to be institutional investors such as pensions and mutual funds. Hedge fund managers playing catch up are likely the culprits. This was an interesting take, and I'm not going to get into all the details, but I wanted to bring it to you because recently I had done a video about the Federal Reserve looking to potentially do a backdoor bailout to the hedge funds. So here they are, buying up everything right at the last minute. They have been really struggling. A lot of hedge funds have been closing down. A lot of them have had their dismal performance over the last few years, and so now they're playing catch up. This isn't a good thing at this time, but this is the direction it's heading. Now, maybe the Federal Reserve needs to be able to apply that liquidity directly into these hedge funds and not have to worry about the clearinghouses, not have to worry about the middlemen because they themselves are in trouble. That's a whole different story. But don't let the Federal Reserve play dumb. They know exactly what's going on. In September, when the repo crisis happened, they were suggesting that, oh, you know what, this is not a big deal. We're just going to fix it up in a couple days. They knew the severity of the problem, and yet they did so because they didn't want to freak out the markets. They told everybody, don't worry, we're going to take care of it. Here we are several months later, the problem still persists every single day. I had covered this when the article first came out, but I want to touch on it again because I didn't get into it in depth at all. He was interviewed by Bloomberg and had a few things to say, one of which is related to what we're talking about today, and that is ETFs. Big short investor Michael Burry predicted the housing crisis. Now he's calling passive investment a bubble. Now, of course, he gives his reasons for this. He's not just saying that because everybody buys them today. Let's talk about why. In the fourth point, he said this: the investors said the exchange-traded funds and index-based assets focus on larger companies and leave smaller value stocks orphaned around the world. I've got a full breakdown in the next article here. The third paragraph is where it gets interesting. The recent flood of money into index funds has parallels with the pre-2008 bubble in collateralized debt obligations, the complex securities that almost destroyed the global financial system. The CDOs are extremely important. If you haven't read about these, my goodness, this is worth a read. Truly amazing how we look at it at the time and, oh, well, there's nothing wrong with it, but looking back in the rear view mirror, it looks a lot more dangerous than at that time. Every single bubble is like this. Burry, who made a fortune betting against CDOs before the crisis, said indexed fund inflows are now distorting prices for stocks and bonds in much the same way that CDOs did for subprime mortgages more than a decade ago. The flows will reverse at some point, he said, and it will be ugly when they do. And there's something that I say all the time, like most bubbles, the longer it goes on, the worse the crash will be. We know that everything must revert to the mean. We see this over and over again. So the higher up it goes, the harder down it will fall. That is a historic pattern that appears all the time. Right from the top here, central banks and Basel III have more or less removed price discovery from the credit markets, meaning risk does not have an accurate pricing mechanism in interest rates anymore. And now, passive investing has removed price discovery from the equity markets. Simple theses and the models that get people into sectors, factors, indexes, or ETFs and mutual funds, mimicking those strategies, these do not require the security level analysis that is required required for a true price discovery. That's why we see the valuations today are ridiculous, and many have said they don't even matter anymore. Well, that's up to you to decide. I'm just showing you what Michael Burry had to say. This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis. In that price setting, in that market, was not done by fundamental security level analysis, but by massive capital flows based on Nobel-approved models of risk that proved to be untrue. It's going to get a little technical down here, but I really want to cover this. I'll be as quick as possible. The dirty little secret of passive index funds, whether open-ended, closed-ended, or ETF, is the distribution of daily dollar value traded among the securities within the indexes they mimic. Remember, this isn't the index. They're mimicking an index. So many investors seem to not realize that. In the Russell 2000 index, for instance, the vast majority of stocks are lower volume. Today, I counted 1,000 stocks that traded less than $5 million in value during the day. Through indexation and passive investing, hundreds of billions are linked to stocks like this. The S&P 500 is no different, over half of them being under 150 million. That sounds like a lot, but trillions of dollars in assets globally are indexed to these stocks. The theater keeps getting more crowded, but the exit door is the same as it always was. All this gets worse as you get into even less liquid equity and bond markets globally. That, my friends, is why I read you all of this. The theater keeps getting more crowded, but the exit door is always the same. So here's the theater, everybody's piling up, but that exit door is still the same. So all the people piling up here have to fit through this exit. Well, how does that work? Typically, when you have individual stocks, you're going to have a lot of exit doors all the way around here. Tons of them. And people can exit when they desire. And of course, in times of crisis, you do have problems with these exit doors because still there are so many people trying to get out that you will have issues. And you know this when you go to any sort of stadium to see a sporting event, you notice this happening all the time. There are delays, there are problems, but anyway, I'm going off track. I hope you understand why I spent all this time on this particular issue. People need to learn about it. This here just shows you probably can't see it at the top of the screen from Financial Times, net investor inflows into ETFs. Look at BlackRock. They are absolutely on top of this. Vanguard, State Street, Charles Schwab, and others here. People need to focus not on the fact that, they own a few $1,000s worth of their ETF or, they got their 401k and so on. We're talking about these major institutions that are the big players. Look at what's going on with ETFs. I'm not saying that you shouldn't get into ETFs. I'm not saying that you should do this or that. I'm trying to make you aware of the risks so that you are more educated with your decisions. If you found the video informative, hit that thumbs up button. When you do, you are supporting me, so thank you very much. If you want to learn about business, about passive income, how to make money, then this course is for you. It's a free e-course, teaches you step by step. Check it out at the AmazonGPS.com. If you want all of the financial information that was left out of the school system to teach you step by step how everything works, front to back, A to Z, I created these 2 books to make it easy, no jargon, no garbage. Check them out, link in description. If you want the audiobook, themoneygps.com. Okay, so you're still here at the end. You are definitely one of the Money GPS subscribers. I want to thank you for staying all the way. Have you seen this video? It's definitely an important one. I just recorded it previously to this one. You got to watch it. See you there.